All right, this one comes from Sims. They say, we acquired a 24-unit multifamily property with bridge debt. The project is taking longer than expected. We are 80% occupied and need a little more cash to get this fully stabilized. Below are the numbers. Any suggestions would be greatly appreciated. Here are the numbers. Number one, we purchased for $1.495 million. Number two, renovations to date, $350,000. Number three, still need $185,000 to complete capex. Number four, as is value is $2.6 million. And finally, as stabilized value will be $2.95 to $3.2 million. Thanks.
All right. So Sims, I call this, or we call this in the industry, bridge to bridge. Meaning you're in a bridge loan right now, and it's I don't know if it's a 12-month or 24 or 36-month. Let's just assume it's a 24-month bridge loan. You started doing the renovations. You started renovating the property, leasing it up at the higher market rent, and now you're 80% occupied, which is great. But you're still not ready to go small balance agency debt because you need 90% occupancy. You still need about $200,000 in capex. So when you go to bridge, the problem is that a lot of lenders think like, okay, well, they're concerned. They're concerned that you didn't achieve your goal in the first bridge loan, right? So now you're extending. So they're a little bit harder to navigate just for the fact that like it's a little concerning to underwriters. Like bridge to bridge, like, well, how come they're not performing? But I think you've done enough here. I don't know what the occupancy level was when you acquired the property, but they would want to see a T12 trailing 12-month profit and loss. We get these done. I just want to let you know that when you go bridge to bridge, it is a little bit more challenging because you're putting doubt in the credit committee's mind because like, okay, well, are they going to perform? They had 2 or 3 years to do this and they haven't got to where they thought they were going to get. The nice thing is that if this property is worth, let's just call it 3.1 million stabilized, and I go to 70%, that's $2,170,000 as far as the biggest loan I think I could do for you. So you only owe 1.5 plus you only owe 1.85. So I think we could pay off the existing debt owed. And I don't know if you came in with 350, if that was out of pocket or if that was the bridge lender that made that loan. But I think we could do a total loan amount of about $2,170,000, which is 70% of the stabilized value. We would fund control the $185,000 for renovations. So it looks achievable. I think we just got to paint the picture like, okay, well, it was during COVID, there was shortage of supplies. We all know that. So I think we could paint the story, and yes, we can go bridge to bridge. Not sure of your existing terms right now. Obviously rates are up more than they were probably when you originated this loan. So we got to work that all out, but it sounds like you're at the final stretch and it looks like 6 months from now, you could be maybe completely stabilized and then refinance out. So yes, I think we could do it. I would just need to get on the phone with you and discuss those topics we talked about briefly just now. Hope that helps, Sims, and hope to talk to you soon.
Hi, this is Bo Eckstein, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again.